Hi all, welcome to TCM Education. My name is Michael. I'm the analyst and the content developer here on the channel. And tomorrow we will be on air for 2 months tomorrow. Not a lot of people are engaging with us through the comments or to the email, but those who are, thank you, keep doing it. You are not disturbing us. We will reply to all your comments, and hopefully will help you become better traders. And some of you are obviously day traders, which is the main purpose and content creation in this channel. Okay, so one unique question that basically covers everything that we've been asked for is how do I focus? We have 6,000 stocks. Where should be my focus? Should it be on Nvidia or Robinhood? Should it be on small caps or large caps? Should it be on IPOs or small caps that are gapping up 100% in 3 days? Those reverse split stocks. Because there are so many opportunities. That's what makes the US equity markets so great. You can look left and right. There is an opportunity. Can you take advantage of that? That's why we are here. We want to take advantage of opportunities, and those who traded 5 years ago, 10 years ago, 15 years ago, like me, and maybe there will be hopefully even more experienced traders know and hopefully acknowledge that this is by far the best trading market ever. I mean, maybe there were better trading markets once upon a time. Since I've been trading just before the market crashed in 2008, that's nearly 18 years, almost 20 years. So I remember my mentor, Meir Barak, and his mentor, Chris Mercer, rest in peace. And I think they would both agree that this is, they're not trading anymore, but this is by far the best market ever. This 2025 in particular. So where should be the focus? Okay, where's the focus? In front of you, you have the list of stocks that are reporting earnings today, and you can see here a bunch of stocks, starting with Coca-Cola. Those are that have the sun to their left. Are reporting this morning. So Coca-Cola is reporting this morning, Philip Morris, Raytheon is reporting, DHR is reporting, Lockheed Martin, and there are plenty of additional stocks that are reporting. On the second page, together today there are like 80 stocks reporting in the pre-market and in the aftermarket, and to those there are another dozens, if not more, that reported yesterday after the bell, and they are joining in. So how can you focus on so many stocks? You cannot. You cannot focus. But you can decide that you have a strategy, okay? And apply a strategy is super important, because if you don't apply a strategy, you waste your time. You're not going to be looking at the biggest movers, and you're going to be spending time on stocks that are most likely not going to develop into big winners. And this is the main gig here, is to catch those stocks that can develop into I would say I don't want to talk about dollars, but can develop into 5% to even 10% intraday movers. That's the market. That's the difference between this market and the market from years ago. In the market of years ago, we wouldn't dare talk about percentages because it was ridiculous. You cannot make a great return intraday. That changed. You can make a great return on a stock intraday today. What do I mean by a great return? 4%, 6%, 3%, maybe a 10% intraday return. Now, why is it important? Because everybody takes different positions, everybody thinks different, but everybody can, if you trade the US equity market, start with money position. $5,000 per trade, $10,000 per trade, $20,000 per trade, or $50,000 per trade. That's your personal option. Okay? If you have enough liquidity in your account, the broker will give you the leverage, or again, I'm not going to get into it because most of the US brokers will give you 4-to-1 intraday. So if you have $30,000, you have $120,000 of buying power. You can easily put on a position $20,000, which is 1/6 of your buying power. And then on that position, risk no more than 2%, and in many cases no more than 1%. So the goal of the strategy that I'm talking about is to take very little risk, take a measured position money-wise, okay, and you don't care, and that takes another issue out of the equation, which is okay, I'm not going to trade a $100 stock because it's too expensive. And how many shares do I have to trade if I'm trading Nvidia? How many shares I have to trade when I'm using trading Facebook, which is $700? So all those issues don't matter anymore. Trade a constant, really constant position, and the position should be according to your account. If you are trading an offshore account, maybe 10 grand is too much. Trade 5 or 8. And if you are a US trader with according to the PDT rule, you can easily trade the 20 grand. But again, that's not my position to advise how big your position will be. It's your decision. I'm just suggesting trade a constant per trade position and a constant per trade risk. Now, how can you do it? It doesn't make any sense. It does make sense, and I will explain in a minute how. Okay, so first of all, in order to achieve the goal of trading per position the same amount and per position the same risk, you need to achieve a common ground. And the common ground is that you want to trade very liquid stocks. I talked about this concept many times, but I don't think I hit the right let's put it the right amount of traders. But it's very important. So we want to trade stocks that are very liquid, at least 5 million shares. So in the first minute, I won't have anything to trade. I mean, it takes time to build this volume. 5 million shares. In order for me to start trading in a position, I need for it to reach at least 5 million shares. Of course, Nvidia trades in the pre-market 5 million shares. So that's fine. I will probably not trade Nvidia. And the stock price should be over $10, not a big deal, because if I lower my standards under $10, there will be a lot of stocks here in this list, and I won't be able to cope with them. Okay, so and their volatility is, of course, a volatility of a $5 stock is sometimes too much, and I don't want to deal with those. And now the most important thing, I want the intraday range to be over 10%. What does it mean? I explained it. I will explain it again because that's super important. We want the intraday range of the stock to be very big, and for it to achieve a powerful move. What does it mean? When the stock is $100, in order to reach this percentage range target of 10%, it needs to move intraday $10. Okay, so imagine the S&P 500 is $600. It needs to move $60 intraday. No, most of the time the S&P 500 is not moving $3 intraday, which is, of course, an issue for us. That's why we don't trade the S&P 500, or most of us will look elsewhere. So that's crucial. Now, what you see here is a list of 28 matches that have been populated last night in this list. Okay, some of those stocks enter this list at 3:58 p.m. and some of the stocks enter the list at 10 o'clock in the morning, 10 a.m. Okay, let's see one that, for example, entered the list very early yesterday, ALAB. Now nobody knows Astera Labs. I don't know either. This is how it looks on the daily chart. You can see the daily chart, and this is how it looks on the 3-minute chart. Now, if your strategy is to trade ALAB, okay, we can discuss the entry points. But I'm not going to do it because in order to discuss entry points and strategy, that's a different story. I want to talk about the concept. So again, you can see that the stock is gapping up more than 10%. The price of the stock is $120. It's immediately, and assuming the volume is growing in the first minute, so after 10 minutes or 15 minutes, it's in the list. Of course, it's not my only list, but it's already in the list. And then I follow, and I'm looking for a trade in this stock. Obviously, I'm not going to look for a short trade because the trend is clearly up. And another part of the strategy is that I'm looking for low risk trades. What does it mean, a low risk trade? Most of the time I will refrain from buying a breakout. So a breakout where the risk, let's say the breakout is 120, the risk is 115, that's a $5, which is 5%, translates into a 5% risk on the trade. I'm not interested. What I'm interested in is trading risk of up to, based on the chart, 1%. So if I'm using the 1% strategy and my position is $10,000, in this case 80 shares or 85 shares of ALAB, I'm risking $100. And if I have more money and I feel more confident or my risk appetite is bigger, I will use a $30,000 position. And why it doesn't matter how big my position is? Because I'm trading individual stocks that have at least 5 million shares, because if they don't have 5 million shares in volume, they're not in this list at all. Now, because I'm trading a money position, I could care less about spreads and how many shares I'm buying. I mean, if I'm using a US broker, I don't pay any commissions anyway. If I'm using an offshore broker, I do pay some commissions. Tough luck. That's the benefit of US trading with a US broker. But again, there are other benefits that you can get. Maybe better execution if you're trading an offshore commission. An offshore broker. Sometimes the execution is better, but that's beside the point. We're letting each trade risk. The risk on each trade is at the most 1% of our position. So that's basically the catch, the trick here, not to get involved with anything that's above 1% of risk. Trade the same concept on every trade, the same position, and look for, let's call it the kill, and the kill can be at 2 p.m. and the kill can be at 12 noon. You don't necessarily have to take the first trade in the morning. I mean, if you're using this strategy, a breakout over, let's say, 100 in a stock, and you feel confident, by all means do it. Okay, those trades will add up and be super important to your bottom line. And the ease of doing these trades, once you catch them and practice this strategy, and we're teaching it. Actually, we have an 8-hour mentoring, only 8 hours. 8 hours of mentorings and another 10 hours of practice if necessary. We had tremendous success with teaching this strategy. I join everybody. I hope some of you will join. If you don't join and you want to do it yourself, do it yourself. That's why our channel is for. So that's one example from yesterday. Let's take a look at another. Now, CLF. Who's looking at CLF ever? Nobody. Yesterday it had earnings. It gapped up more than 10%. You can see from 950 to 1050. So it hits the list. Then you observe the pattern. The pattern tells you the risk is 8 cents. Let's call it 10 cents. That's less than 10%. And the stock moves from 1040 to 11 and drops and closes at 1060. We have also a strategy how to manage those trades. And the strategy is some of you won't agree, others will agree. We don't manage the trade. We are the believer that once we worked so hard to pick up those stocks must close, and some of them are, others won't, at the high of the day. And what is the high of the day for CLF? Obviously, it didn't close at the high of the day. But as there will be those stocks that will close up, you buy at 10 and they will close up at 12. That's a 20% intraday gain just for waiting 3 hours and doing nothing. Okay, so a 20% intraday gain on a $10,000 position, that's 20%, that's $2,000. Just to make your instead of taking partials and adding and paying commissions if you pay commissions and managing. So you put this trade behind you, and sometimes trades disappoint and run away. Meaning, what does it mean? It runs away. It comes back to the entry, and you stop out zero money on the trade. And sometimes they will be a 10% winner, and sometimes there will be maybe more. Let's say on average you have a 3% winner. And the idea here is to create, and we can teach you how, or you teach yourself how to get involved with 3 to 5 trades per day. If you trade in the US, who cares? I mean, you don't pay commissions. If you trade outside of the US, you may pay some commissions, but your worst scenario is that you're losing 1% per trade. That's one part of this trick. Okay, guys. Again, I will come in and talk about today's price action over lunch. The videos obviously take time to reach the media once we process them, and so nothing is online. Once we're going to get hopefully more engagement from you, we will come on live. We were hoping to do it already. Also, the coming on live is a bit complicated for us, but we will do it with your help. So thank you, and we'll see you in the next video. Please like, subscribe, and more important than anything, engage with us, email, and if you're willing to take our classes, even better.